Very good morning to all of you, dear students. Today we are going to get started with the new subject, financial management. To give a brief about this subject, first of all, if you look at the role of professionals like us, chartered accountants, cost accountants, and company secretaries, over the years, it has undergone a major change. I can tell you that when I qualified somewhere almost 30 years before, the expectations from a professional like me or us was rather to maintain books of accounts and have have to ensure that we meet the reporting requirements. Okay, for all the stakeholders, preparation of financial statements and all that was major role what we did in the earlier days. But that has undergone a major change because of 2-3 reasons. One is technology. Technology has brought in rapid changes into the way we operate, and consequently, a lot of things which we used to do as accountants are now replaced with softwares. What I mean to say, today we have an accounting software which does most of the work for accounting, and we as accountants are only generally supposed to do the basic work. To be honest with you, we used to do manual accounting where we used to tally trial balance manually and it will never tally so easily. So we used to spend day and night to even do that. Is that the case today? Today, there is no such thing like untallied trial balance because there's a software which takes care of that. I just need to key in the data. See, as an accountant, as a professional, I need to know how to key in a data, pass an accounting entry or record a transaction, and everything is automatic. I need not worry about. Once I code it and set it. For example, if I say stock is current asset, I code it as current asset and leave it at the time of creating a software, then everything is taken care by the software. Like that, everything I code it at the first stage, I record a transaction, and everything is automatic. I generate a trial balance or a P&L or a balance sheet at any point of time or a cash flow statement for that matter. So the role of accountants is limited to the extent of doing the initial setting up and then on a routine basis ensuring that the recording of transactions happen properly. That is okay. That is still there. Computers cannot do everything. So, but what has happened after that? So, our role as accountants has undergone a major change and we are now playing a bigger role in the current times. What I mean by the bigger role is financial management. Financial accounting, which was a core area for us. Today, now financial management has become the core area. And not only that, compliances, company secretaries, cost accountants, chartered accountants, we are all expected to ensure compliances. This is another major area where we are playing a key role today. So our role has undergone a major change as professionals from just an accountant to finance managers and compliance authorities or people in an organization who are supposed to ensure compliance of various regulations. Direct taxation or indirect taxation like GST, be it corporate law requirements, be it SEBI requirements, be it anything and everything, we as professionals are expected to have proper understanding of it to ensure smooth operation of our entity. So are you able to follow what I'm saying? Yeah. So this has been a major change or shift in expectations of the stakeholders from professionals like us. What has happened over the last 20-30 years. So that brings us to the point where this subject as financial management, what we are going to cover, is something very, very important and assumes greater significance because unless we do our role as finance managers properly, we don't add value to an organization. I think I have told you sometime probably. I'll again repeat it for the sake of those who have probably not heard me saying it. In an interview in Hindustan Unilever, the question that was asked to me was, what value addition you have done to your company? I think I would have told you this probably, but it's okay to repeat it. What is the value addition you have done to your earlier company? I couldn't answer that. To be honest with you, I answered it by saying that no, sir, I prepare accounts, I do balance sheet, I do this, I do that. Then he said, no, no, what value addition? So I was actually a bit shocked at the time in the interview because I thought they're expecting me something else, but which I have not done probably. So I thought I may not get the job. Then it took me time to understand what is value addition. As a professional, we are expected to add value to an organization. If an organization is going to pay us as professionals a salary of something like, let us say, 25 lakh rupees per annum, expect us to add value to the extent of minimum 1 crore to the organization. That is 4 times of what they pay to us. It's like no cost benefit analysis. You all agree to this point? If somebody is going to offer you a salary of 25 lakhs, is it not appropriate for them to expect that at least I give 1 crore worth of benefit to the company? In what form I can give benefit to the company as a professional? Now, as a finance manager, I have a major role to play in value addition. What type of value addition I can do? I need to ensure that the organization saves money when I decide on certain decisions, like for example, capital structure. I need to decide on capital structure of my organization by optimizing my debt equity. I need to ensure that the objectives of my entities are duly met by ensuring a proper debt equity ratio. Not only that, we are going to understand what is the role that is being played by a finance manager or a CFO. Forget about the designation. Be clear on the role played. In fact, today's lesson, what we are going to go through briefly as overview of financial management. This is such an important area for you to understand the role of a finance manager and what are all the things a finance manager is expected to do to add value to an organization. So I say, as finance manager, 1 crore rupees interest to the organization by optimizing the debt equity ratio. Then I add value to my organization. That is what is intended by asking me a question, what is the value addition you did? I can tell that, see, when I joined the company had a debt of 100 crores. I joined as a finance manager. I reduced the debt to 60 crores. Balance 40 crores, I went for IPO. As a finance manager, I decided to take up an IPO, and share capital, you all know, dividend is not compulsory, at least in the initial time. So 3-4 years, I need not even pay dividend. I went for IPO, 40 crores IPO, 60 crores is my debt. I saved 10% or 15% interest on 40 crores. So when you go for an interview today, the question they ask you is, do you have an experience of financing? There are so many options available for financing today. We are going to discuss that also in little more detail later. So debt financing, equity financing, you can finance through debentures issue. It's a type of a debt financing. You can issue shares like IPO. You can go for a term loan. You can go for a working capital loan. So there are so many areas in which you can do funding or financing of a business. So today that is more important. And another area where we are going to play a key role as finance manager is about decisions regarding investments. Investment decisions. What type of investment decisions we as finance managers do? Whether, take for example, I'll give you ITC Grand Chola Hotel in Gindi, Chennai. Many of you would have seen that. Can you guess what is the money that was invested in building up the property? This was built some at least 15 years before, to my memory. Just let us assume so. 10-15 years before this project was done. And any guess how much it would have cost for, it's an IPC owned company, you all know that. So how much of cost or investment the company would have made to put up the project? Any guess?
$15 crores.
Sorry, 50 crores, 50.
15, sir.
15, okay. So this property was put up, investment in a property for ITC was done some 15 years before. So probably you're assuming it is to be 15. Okay, any other answers? Any guess? Nobody wants to make a guess on that. என்ன இன்வெஸ்ட் பண்ணிருப்பாங்கன்னு ஒரு கெஸ் பண்ண சொல்றேன்.
Be on the higher end, sir.
Maybe on the higher end. So any guess how much it could be?
Maybe 75.
73 crores. Okay. So Preeti, what is it your guess is?
Around 100 crores or below that.
Around 100 crores. Okay. So Srinidhi.
80 to 100 crores, sir.
80 to 100 crores. Okay. So it looks like Srinidhi was a finance manager and she's there. It took 80 to 100 crores. Like she's giving a band. Very interesting. Madhurita, any guess?
100 crores, sir.
100 crores. Rahul. Okay. No, fine. Good. Thanks for your answers. So, though I also don't have an exact answer, I can also make a guess. It was easily some 400 to 500 crores at that time, easily. Because if you look at the site itself, it's a prime location and all that. Even the land costs would cost you so much because it's almost running into acres probably. And so the building with that land and all that would have costed the company 500 crores, just as a guess. Okay. So if a company is going to invest 500 crores on a property, then it has to expect some good returns from that also, right? Now this is an investment decision. So as finance manager, we need to enable the organization to take decision whether at all I should invest. So we are going to understand something called capital budgeting. In fact, the financial management subject, we are going to cover topics. First of all, maybe I'll be starting off with ratio analysis or analysis of financial statements. Analysis of financial statements. That's something I probably start off with. Though, as I said, it can even be categorized as subject under the management accounting subject, doesn't matter. So the first thing as professionals we are expected to do in an organization is analysis of financial statements to take various decisions. So why do we do analysis of what is the current ratio, what is the debt equity ratio, what is the dividend payout ratio, what is the earning per share, what is the price to earning ratio? We do analysis of various ratios in order, what is the debtors receivable period, what is the creditors payable period, how long it takes for me to collect money from my debtors, how long it takes or how long I take to pay my creditors, what is my working capital cycle. I analyze so many things as a finance professional. Then what I do, I ensure that I carry out proper working capital management. So as a role of a finance manager or a CFO under financial management, I am expected to carry out a proper working capital management. So that is part of your syllabus. Coming to the academics part of it. So your syllabus in financial management is going to comprise of topics like ratio analysis or analysis of financial statements. Then you got a working capital management. Then, as I said, debt equity ratio and all that will enable you to decide on capital structure. Capital structure, determination of capital structure, and ensuring optimum cost of capital. The cost of capital is nothing but, as I said, when you're going to borrow or when you're going to borrow in the form of debt or issue debentures or do whatever you want, then you need to optimize it. You can't always minimize it, but you can optimize it. So optimization of capital structure and optimization of the cost of capital is another important role we play as finance managers. So as finance manager, we play a role of analyzing the financial statements and taking decisions. Secondly, ensuring proper working capital management. So working capital management is something so important. Without a proper working capital management, you can't operate your business at all. That is the money you need for a day-to-day operation. Then we have decisions, as I said, regarding capital structuring and determination of or optimization of cost of capital. Then capital investment decisions, which is referred to as capital budgeting. If I invest today, whether I'm going to get returns adequate enough for justifying my investment. Now you are all making an investment in studies. I always used to tell this example. What is your payback period? This is a concept we use in capital budgeting decision. You are investing how much in your study for your course. You're doing a CA or CMA or CS, how much of money you're investing over the 2-3 years time whenever, so starting from your foundation level, then intermediate, whatever name you give it, no, final level. So 3 to 4 years you all study. How much of money you invest in your course, studying your course? Overall, how much you spend?
2 to 3 lakhs.
2 to 3 lakhs. Fine. So inclusive of all your books, coaching fees, then you have institute registration fee and all that. So 3 lakhs, 2 to 3 lakhs, perfect. Okay, 2 to 3 lakhs. Generally, all of you agree to that number. Okay, something like 2 lakhs in my view, it's okay. Even if you want to put a higher number, 2.5, 3 lakhs. Now, you all have chosen this course because this course offers you opportunities and all that. But your parents would have thought of it in a different way also. They would have thought, enna masala 3 lakhs. Okay, fine. I'm okay with that. They're making an investment decision. Now, how long it takes for you to get back to 3 lakhs after you qualify? Salary or earnings potential of a professional. After you qualify, how long it takes for you to get back to 3 lakhs? Period. Times. You can tell
1
me
year.
1 year to 2 years, sir.
you have invested 3 lakhs in your studies. It's going to take 1 year to get back the 3 lakhs, or how much it's going to take for you to get back your 3 lakhs?
Within a year, sir.
Within?
Within a year.
Within a year. Okay. So any other answer? Today,
On the company that we joined, sir.
correct. See, correct. What you say is right. What I say is you qualify as a professional today and you join a company, decent company, offering a decent salary. And so keeping that assumption, how long it will take for you to recover this 3 lakhs, the investment what you made? In my view, it should not take more than 3 months time. On an average, 1 lakh is the salary today for a professional. Once you qualify in a good company. Even if you assume 75,000, 4 months. Okay. As you said, even if you assume that 50,000 per month, it's going to take 6 months for you. That's all. So there's a question of 1 year, 2 years, 3 years, nothing like that. So it's an investment decision you're making in your life. I will do a course like CA, CMA, CS. Within 3 months, 4 months, I get back my money. And after that, whatever I make is profit sort of. So this is an investment decision. Do you agree or you disagree? Because a long-term decision. So similarly, in a business environment, as professionals, we are supposed to take some decisions on investments. If I invest today 500 crores in a property like ITC example I gave you, how long it is going to take for me to get the payback? Because using the property, I'm going to make profits. Correct? I'm going to make revenue profits using the property. I'm investing 400 crores on a property. My annual profit should be 40 crores. So at least 5 to 10 years because long-term project. So the payback period can go up to 10 years also, no problem. Because businesses are intended to be for long-term, not for short-term. That is why you find the corporate news coming up as expansion, diversification, acquisition. Now this is where today startups funding want to join as a manager of a finance manager of a startup company, they would expect you to fund the business. Because startup can get the fund correct. Startup funds correct, then you can't go to a bank. If you want to go to a bank, you need to have a track record of profits. Where do you have a track record of profits? Venture capital funding is only venture capital funding. There are a lot of agencies today which offer venture capital funding. So as a finance manager, I need to be understanding that properly. I need to play a key role in venture capital funding. So capital budgeting, investment decisions, another major area. Then another area where we play a key role is about dividend decisions. One of the important decisions, every company will have a dividend policy. That is, out of its profits, how much of it is going to give us a dividend? How much of it is going to give us a dividend? All of you opened a demat account by this time?
My sister has the demat account, sir.
Your sister,
As I
your elder sister has got a demat account. Okay, great to know. Okay. When you open a demat account, you know these things that dividend. As a shareholder, you will receive a dividend. 10 ரூபா dividend வந்தாலும் you'll be very happy. இன்னைக்கு 10 ரூபா யார் தருவா? நான் அடிக்கடி சொல்வேன் இல்லையா? Have you ever seen purse of your friend? Or have you ever seen purse of your relative? அந்த காலத்துல பர்ஸ் எல்லாம் தைரியமா ஓபன் பண்ணுவோம். இப்பெல்லாம் யாரா பர்ஸ் வச்சிருக்காங்களான்னு தெரியாது. Of கார்டு இருந்தா ஓகே. So what I mean to say is today, funding and finance is a core area. As finance managers, we have to decide on how much of dividend I'm going to give shareholders. I have to keep in mind long-term growth as well as short-term dividend. So that is another big area. So dividend decisions. All these are part of a syllabus only. We are going to discuss this as separate topics. So ratio analysis or analysis of financial statements, working capital management, capital budgeting and investment decisions, dividend decisions, and cash flow statements. That is also part of analysis, which can either come under financial management or management accounting or whatever. Then fund flow statement. Some of you have got fund flow statements. Fund flow statement is today more for academic requirements, you need it, but it has been replaced with cash flow statements. So this is the scope of the subject. I am trying to give you a picture about the subject first of all, because you need to understand what is financial management. Managing the finance of the business is financial management. How do you manage the financials of a business? As I said, these are all the things you do. And another area which I want to touch upon today is about the objectives of financial management. What are we trying to achieve by carrying out this financial management? There are two major objectives of financial management. Any idea what is it? We were
Wealth
discussing about the role of
maximization.
financial management. Yeah, the objectives of financial management. What are the two major objectives? Any idea? Have you come across that?
Profit maximization and wealth maximization.
Very good. Profit maximization and wealth maximization. This very interestingly, these two objectives of financial management clearly tells us what the finance manager should do. The finance manager should focus on these two areas. Profit maximization, which is expected to be in the short term. On a year-on-year basis, you should focus on profit maximization. Secondly, wealth maximization. As a finance manager, we are expected to maximize the wealth of whom?
shareholders.
Yeah, stakeholders, shareholders, and of the enterprise company. Okay, when we say wealth maximization is primarily of shareholders, I do agree with you. But what I intend to say here, add on with it is, as a finance manager, we have a role to play to maximize the wealth of our organization. So ITC, I told you, I invested 400 crores 15 years before. Today, any guess what would be the value of the property? If I want to sell my business, hotel business, I want to sell. I have invested 400, 500 crores 15 years before. Any idea what will be the property's worth today?
Only 1,000 crores, sir.
Good. Should be easily around 1,000 crores. So I have doubled the value of my enterprise. Do you agree? I have taken an investment decision. In the process of taking an investment decision, I have also added the value of my business entity. So when I'm going to set up a plant, when I'm going to set up an office, when I'm going to set up a factory, or when I'm going to set up a hotel or a hospital, or when I'm going to acquire it, there are a lot of advantages because I'm adding wealth not only for my stakeholders but also for my enterprise. Let us see, ultimately, enterprise wealth is what is going to be reflected as wealth for shareholders eventually, because that is going to get reflected in the share price. Now there is something called price to book value, share price. What is a book value? Book value is nothing but the net worth of the entity divided by the number of shares is a book value per share. Net worth நாலே உங்களுக்கு என்னன்னு தெரியும், your equity plus reserves. On the liability side, அதே asset side ல வந்தோம்னா fixed assets plus current assets minus current liability, that is fixed assets plus working capital. is your net worth. Do you agree? So your net worth is a reflection of what? Your financials is basically comprising of assets and all that. So my balance sheet is, I can even revalue my balance sheet assets. Like fixed assets, I can revalue. Today, I can revalue my assets, fixed assets like building and land and building, and take it to revaluation reserves. That is going to add to my wealth of my entity. Okay, so wealth of an enterprise has to increase also, improve also, and not only that, and we are also going to work on maximizing the wealth of shareholders. How does the wealth of shareholder gets maximized? I gave you an example, a lot of examples to give, but at least I think I have given this to you, which is readily on top of my mind. TCS, I gave an example. TCS, when they came up with, okay, this company has been operating for 30, 40 years now, no doubt, but when it came to an IPO sometime in 2004, a 10 rupee share was offered to shareholders at somewhere around 800 rupees per share. A 10 rupee share was offered at somewhere around what? 850 rupees per share in 2004. We are in 2022, 18 years is gone. You know what value or wealth it has given to the shareholders? It has given 30 times wealth to the shareholders. 30 times wealth. What does it mean? It means had I invested 1 lakh, in 2004 in purchasing shares of TCS, today my worth is 30 times of 1 lakh, 30 lakhs. So no other opportunity is available to you to multiply your wealth 30 times, other than probably which comes very close is maybe real estate. Maybe, but not even real estate. Because real estate, to my knowledge, has offered you a return of, if I invested in 2010, something like 20 lakh rupees, today it's 1 crore, 5 times only. Carefully understand my example. Real estate is offering you a 5-time return in a 15-year term or 20-year term, whereas a share has offered you a 30 times return. This is wealth maximization. Wealth maximization of promoters, wealth maximization of shareholders, wealth maximization of all stakeholders. That is why companies offer you ESOP and all that. It's a wealth maximization for employees. They give shares, they become shareholders. So this is another area which finance managers have to play a key role. So finance managers have to play a key role in profit maximization in the short term, which includes decisions regarding financing the business like working capital management and capital budgeting and cost of capital and all that area he has to focus on, so that he optimizes the cost of capital and generates more profit for the business. There are a lot of things a finance manager can do. Okay, so we'll be dealing with it one by one. And this is a short-term objective for a finance manager, profit maximization. But if you look at the long-term objective, the major area he is to focus on is wealth maximization. So wealth maximization is basically number of shares into, you would have heard of this term called market capitalization. You would have heard of this term called market capitalization. Market capitalization is nothing but number of shares of the company into market price per share. And so if I have 1,000 shares of TCS today, which I probably bought some few years before, and multiplied by somewhere around 4,000 rupees. 4,000 into 1,000 makes it something like 40 lakh rupees is my wealth because of owning a share. So every finance manager has to play a key role in maximizing the wealth of stakeholders. Have you understood this point? So profit maximization in the short term and wealth maximization in the long term. These are the two major objectives of a finance manager. So for doing this, finance manager plays various roles. Today, that is why our finance profile, role of finance manager in an organization is very, very powerful. Today, nobody can take a decision without approval of a finance manager, because finance manager is going to ensure that these objectives are duly met. What is the point in producing and selling if you don't make profits? You got an excellent product. You have an excellent product, You have got an excellent marketing team. They're selling your product, but can you do that without making profits? No. So that is where finance manager comes into picture. How are you going to fund it? You want to set up a major factory for expansion. There is a huge demand for a product. You are going to set up a new factory. Then you need money for that, setting up that. So you need 100 crores. Who is going to do that? Finance manager. He's going to tie up with banks. He's going to tie up with various venture capital agencies, etc. And he's going to organize 100 crores fund for that. Then only you can start your factory. When you start your factory, who is going to organize money for working capital? Who is going to give money for purchasing goods? Who is going to pay money for paying salary to workers? Finance manager. Today, even in our day-to-day activities, in our household, you know, managing finance is the toughest. Everything else comes next. Do you agree or you disagree? Because we have commitments. Everybody has got commitments, family commitments, everything is there. So parents are the best finance managers available today. Your mother and your father, they do best finance management. They ensure that everything is taken care, all that. So that is the crucial aspect of role of a finance manager. To give you an example about this, how important it is in this working capital management aspect of a finance manager, what he does, a role. In fact, when there was an issue in Satyam Computers, there was a major accounting issue, fraud and all that. It was reported widely, you all know that. And the government decided to take over that company, in the sense, not directly take over, the government intervened and they appointed directors, government appointed directors. And they had the task of reviving the company and cleaning up the books of accounts. Cleaning up the books of accounts means a lot of wrong accounting was there, everything has to be cleaned up. They had to take the responsibility of cleaning up the balance sheet and financial statements. Whatever wrongdoing, they have to undo it. And not only that, they have to ensure the company is running. One of the major tasks they had in hand was to manage the working capital at the time. Because there was no money left in the business to fund day-to-day operations. One of our professional, Mr. T.N. Manoharan, who is a chartered accountant and who was the president of the Institute of CA, and he was also appointed as a director of the company by Government of India. You know, he is a person who was key in reviving the company. So we all should feel proud as professionals sitting here, and you're all budding professionals, where we have played a key role in ensuring that this company, Satyam Computers, was revived, and they eventually was sold. All that happened. But otherwise, the company, employees, everything would have gone for a toss. If the company had closed, then everything would have gone for a toss. But government also took the initiative of ensuring that the company is not closed. And our professional chartered accountant did the major role of, okay, everybody was there, no denying that fact. I'm generally giving as an example only. So he played a key role in reviving the company and ensuring working capital. No bank was willing to give working capital facility because the company is already in a big issue. There was a wealth erosion, the reverse happened. A 300 rupee share became 3 rupees. So all this happened. So finance manager only played a key role in reviving the company and ensuring that the company was operational and they sold it off later to some other company. It's going on now. So it was Mahindra Group and now Tech Mahindra. You know, the name of the company is called Tech Mahindra. So Tech Mahindra has in it Satyam Computers. It became Satyam Mahindra, whatever, Mahindra Satyam. Then later the name was Tech Mahindra. So this is a history of some example rather of what a finance manager can do in a business. Hope all of you are able to understand our discussion. So any doubts at this stage?
No, sir.
Yeah, so today I am allotting the time for getting you the framework of the subject first of all. Then I'll quickly go through a simple presentation for you. And then whatever we discussed briefly, I have just put up in a presentation format for your reference and all that. And then we'll be starting off with first lesson, as I said, we'll be mostly starting off with ratio analysis or analysis of financial statements. Then we will take up working capital management and all that. That's the whole plan as far as the subject is concerned. Okay, so all of you are clear. So this is how I can summarize financial management and role of a finance manager. Generally, in your exam, from academic point of view, you get one question on this subject, lesson 1. Briefly outline the role of finance manager. Briefly outline the role of CFO, CFO function, all that. 5 to 8 mark, 5 mark minimum. You can be assured of one question on this topic what we are discussing today. Our discussions are they have got 2 objectives. One is exam, whatever requirements. Another is knowledge. So both we take care. We ensure that you get adequate knowledge about the subject also, and as well it meets the exam requirements in full. So that's the whole idea behind our discussions today. So each of the points we are discussing today is directly relevant for exam. No doubt about that. It's not a general understanding only, but it's also from exam point of view very, very important. Okay, so let me take you through the small presentation, and let's see how far it goes today. Okay. Able to see the screen?
Yes, sir.
Okay. So, an overview of this financial management. So, it's primarily concerned with planning and controlling of the financial resources of an enterprise. So, financial resources of an enterprise, planning is a start point, controlling is the end point. So, anything you start off with is a plan. Anything you check whether you are acting in accordance with the plan is control. So, financial management is concerned with planning and controlling of financial resources of an enterprise. The focal point of financial management remains maximization of shareholders' wealth by proper consideration of various factors like timing of return, cash flows, risk, etc. Timing of return is nothing but the payback. What I told you, as I said, if you're going to invest 3 lakhs for your course, it takes 3 months only after you complete your course to get back your investment. So that is referred to as a payback period. Cash flows, as I said, is part and parcel of financial management. And not only that, risk management. So whenever you are going to carry out various decisions, you have to also keep in mind the risk factors involved. So we have risk adjusted return and all that, which will be covering as a part of capital budgeting. So that's another area where we have to focus on. Financial management deals with procurement of funds and their effective utilization in the business. Let us take an example. Recently, you would have heard of companies going for funding. Okay, venture capital funding in particular. Today, startup. Yesterday was an important day. What was an important day? Government of India announced yesterday, or maybe I don't exactly, or day before, whatever. Just 1 or 2 days before government announced today is a dash day. What day? Any idea? Government announced, I think, I don't remember exactly, 16th January, let us say. 16th January as or 17th or 18th January, I think. This today will be named as Dash Day. Prime Minister announced this.
This is the Army Day, sir.
You are right. He also announced that. I fully give credit for that. He announced something like that also. But beyond that, something related to our business, he announced something. Current affairs. I shared this.
Startup day.
Sorry, who said that?
Harshita, sir.
Okay, sorry. ஏதோ எங்கேயோ கேட்ட குரல் மாதிரி கேக்குறது. எங்க திரும்ப good, right? Perfect answer. Very good, excellent. It's startup day. Startup is a business which is a new entity, which is starting off on its operation. And who's going to fund it? I told you, venture capital funding and all that is happening. So there are many startups today. This Swiggy or Zomato or Yesterday there's another. Now tomorrow in strategic management, we are going to have a lot of such discussions, interesting discussions. Swiggy or Zomato or whatever. No. Yesterday there was news about Jubilant Foodworks starting a new area of operation. Jubilant Foodworks. Have you heard of this company? No?
Yes, sir.
Yeah, Madrita. So what do they do?
I think that's associated with the Domino's, so I know about it.
Domino's Pizza.
Yeah.
Very good. You're right. Perfect. So Jubilant Foodworks, they are actually operating this brand Domino's Pizza under license from Domino's, etc. You know what is the share price of Jubilant Foodworks? You know the share, you know the price of pizza probably. A country fresh vegetable pizza or pizza enna vela? Average or a large pizza. தெரியும் இல்லையா உங்களுக்கு?
500 to 600.
Sorry?
500 to 600.
Okay, 500 rupees per pizza. Okay, Jubilant Foodworks makes it. We all buy pizza regularly. We all know that. And today, McDonald's, Domino's Pizza, they're all listed companies actually. Burger King. Burger King is a listed company. Jubilant Foodworks is a listed company. And McDonald's is a listed company. The McDonald's is a brand. They operate. Company name could be different. Like Domino's Pizza is a brand, but the company name is Jubilant Foodworks. They came up with some new brand, Popeye or something. They sell some non-veg food. It's a global US brand. They have launched their first outlet in Bangalore yesterday. So these are all the areas of expansion where finance managers play a key role in funding it. To put up in Bangalore an outlet for Popeye, that is the brand name of that. Like you have what is this? KFC, you know, it's equivalent to KFC. That is KFC, you know what they do? Kentucky Fried Chicken. So something of that similar nature, this company Popeye is a brand. To put up a unit or outlet in Bangalore, it would have cost them 15-20 crores. It's an investment decision. And they're going to put up many such facilities or outlets across India. Burger King is coming up with a big plan to set up outlets, kiosks. In another 2 years' time, you'll find when you cross your Velachery or Madipakam, wherever Nanganallur you are, or wherever you are, then you'll find a lot of kiosks, Burger King kiosks, expansion. Who is going to fund the expansion? Venture capital. So they are going to pump in money and they are going to participate with you in the business. It's a startup, sort of startup. Today, startup is buying built-up companies. Farm EC, our company, Farm EC, you would have heard of it. They have acquired this company called what? Tyrocare. So we'll be discussing all of this in strategic management tomorrow. But today, the financial aspect of it is what I'm trying to explain. So Tyrocare stake was purchased from the promoter by this company. And the company name is different. The brand name in which they operate, the pharmacy, chain of pharmacies is Farm Easy. Today, Apollo hospitals, you know, they are into medicine selling. You know what is it through which they sell their medicines? You have an app, 24/7 Apollo app, through which they sell medicines. Medicines come delivery in 1 hour. Today, it's a big business. They've expanded. So this is where, as finance manager, we play a key role. I told you about Jubilant Foodworks. The share price is quoting somewhere around 4,000 rupees per share. Now they have announced a stock split. Subdivision which we discussed. So we as finance manager have got a key role in wealth maximization. This Jubilant Foodworks 10 years before, when they came up with some IPO, the share price was 100 rupees or so. Now 40 times in 10 years. So thank all those pizza lovers. This is what I want you to open a demat account and buy not only a piece of pizza, but a piece of share of the company. So we shouldn't only restrict with being happy with a slice of pizza. Eat it and forget it. But buy a slice of the company by buying some shares in the company. Then you will also add value to yourself. Wealth maximization. Now you will recommend all your friends to go and have in Domino's pizza. Because you're anyway the owner of the company. No? Even if you have one share of the company, you are the owner of the company. You agree or disagree? Yeah. So this is what I want you to get the picture right. So what is it we are trying to do? So moving on. Financial management, as I said, deals with procurement of funds and their effective utilization. I gave an example about acquiring funds from banks or financial institutions or venture capital companies or all that agencies which provide you funds. Then today's financial management involves three types of decisions. One is an investment decision. We discussed that. Secondly, financing decisions, how to finance your business. Thirdly, dividend decisions. Three major decisions. Remember this: investment decisions, financing decisions, and dividend decisions. So I briefly told you what it's all about. Investment decision is typically for long term, and I gave an example about ITC investment. And not only that, a lot of acquisitions, diversifications, etc. keep happening. And wherever acquisitions, diversification, etc. keep happening, investment decisions are involved in it. Now I want to invest. That's great, but where do I get money for that? Something may be internal approval, something may be from external borrowings. So financing decisions comes into picture. That is where I said you need to ensure optimum debt equity ratio, because the more debt you borrow, you have to pay more interest, cost of capital. So you cannot. One of the important cost element in any business is interest from borrowings, cost of capital. You all know what is Ebitda, earnings before interest, tax, depreciation, and amortization. Ebitda. So, I request all of you to keep noting down certain things so that it will be easy for your reference later. So, Ebitda, you would have heard of it, very popular terminology. EBIDTA, earnings before interest, tax, depreciation, and amortization. Ebitda. And every company today, they make some good Ebitda. That is, after gross profit, you have office and administration expenses, etc. After office and administration expenses, you get something, a profit which is referred to as Ebitda. That is something you can call as operating profit. So many companies are making operating profits. You cannot operate a business where you make an operating loss, unless it's something very new where you are taking a risk. So most of the companies make operating profits. That is, they buy, sell goods at profit only. But where the profit is getting eaten up because of the finance cost. The interest part. Of course, depreciation and amortization is a non-cash item, so nothing to worry about it. So it's more of a book profit. But the interest component, the finance cost, is a major cost component for any business. So that is where we play a key role. So you make an operating profit of 100 crores and you pay 200 crores interest. 150 crores as interest. Then what is the point in doing a business? Now, this economic value added concept is an important concept which I want you to carefully hear me. Economic value added is a concept today where what value addition you are doing in a business. Today, if I have 100 crores with me and I go and put it in a fixed deposit without doing anything, I get 10% return. For example, I'm saying, or 5%. I just have 100 crores with me and I go and put it in a fixed deposit. I still get 5% to 6% interest on that without doing anything. Do you agree or disagree? Because fixed deposit, you get interest for doing nothing only. You just put your money there, that's all. But I am going to now invest 100 crores into a business, then I need to get something beyond that 6%. So your performance is measured as if you get a 15% return, 15 minus that 5 you have to reduce, you get actually only 10% return. That is the value addition you have done in your business. So we finance managers closely look at this economic value addition and ensure that we make adequate profits in the business. And that is what we are going to give it as dividend to shareholders. All of you are able to understand what we are discussing here? Clear? Shall we move on? Any doubts at this stage?
No, sir.
Okay, great. Evaluating a business proposal, all that is done by finance managers. Decisions. So decision making is an important area, broadly categorized as investment decisions, financing decisions, and dividend decisions. Now, investment decisions involve investment in both long-term assets, which is capital budgeting exercise, and short-term assets referred to as working capital management. And capital investment decision is a decision of far-reaching consequences as it allocates funds in investment proposals whose benefits are realized in future. So you're going to focus on the realization or profits which are going to happen in the future. So you have to take a decision on that, and very, very critical to take a proper decision, and involves consideration of a risk factor also. So whenever you're going to make capital investment decisions, it obviously involves risk factors to be considered duly, and investment decisions are evaluated in relation to their expected return and risk. So what return I can expect from it, and what is the risk? What is the risk we are talking about? The risk of, there are so many risks associated in the business. There are so many risks. So you have to factor the risk involved in the business, and you have to calculate a return after duly adjusting for the risk. So in capital budgeting, we'll be discussing about risk adjusted rate of return. Risk adjusted rate of return. So every business, we'll be discussing in detail about it in strategic management. Every business has got a lot of risk involved. Today, you all know the issue about the risk around us, environmental risk, what we call. In business, you have internal environment and external environment. Within the business entity, there are some associated risks. Outside the entity, there are a lot of risks. So you have to consider the risk involved in a business while you are evaluating proposals and all that. Then moving on, financing decisions, what does it involve? So investment decisions we discussed is to consider return and risk. Then financing decisions involve selection of the optimum proportion of debt and equity. So only when you optimize your debt and equity proportion, you will be able to optimize your cost, and you will be able to maximize your profit. So optimizing your cost will enable you to maximize your profit. And dividend decisions involves determination of the amount of surplus to be distributed as dividends to shareholders, and provides for how much of profit to be retained in the business. This is called dividend policy. Now, in any business, the finance manager has to consider various aspects and decide on a policy. How much of profit we are going to declare as a dividend? Many companies declare out of its profits after tax, 50 to 60% of the profits they declare as dividend. The balance they retain for future growth, for future expansion, etc. Many companies like Colgate, Hindustan Unilever, they are all offering very good returns in the form of dividend. Now, dividend returns will be good only in the long run for a shareholder. Today, if I go and buy a share of a company, the dividend return will not be great on my investment. But let us say an example, the TCS example what I gave you. Had I bought the share in 2004, today the dividend itself is something like 30% for me, annual dividends on my investment. I gave an example about I investing 1 lakh rupees, correct, in TCS in 2004. Continuing that example, if I had invested 1 lakh in 2004, which is 18 years back, and today on that 1 lakh investment, you know what is the annual dividend I will get? I'll get an annual dividend of 30,000 rupees. Dividend only. Forget about the capital growth. The capital has grown already 30 times. I told you that. So there are, as a shareholder, I am talking about from the shareholder's perspective, because the finance manager role is to ensure wealth for both the company, enterprise, and the shareholder. So the company is offering me a 30% dividend on my investment, which I did in 2004. But if I do it today, it is not that return. I'll get only 1% return. What I mean to say, so investments are to be made in shares at very young age, like that's why I keep saying, no, you're all youngsters, maybe you're students, okay, but when you go for a job, then you should try to take advantage of this corporate no, dividend shareholding and all that. That would be an interest. So I always used to tell my friends and students and all that, when I joined my first company, L&T, my first salary was X amount. Had I invested that X amount or second month salary at least, X amount, in shares of L&T, so let us say it's, for example, 6,000 rupees, because that was my first salary. What is the problem in sharing that information? It's all not a big secret and all that. My salary was 5,000, 6,000 rupees in 1993. Had I invested some 6,000 rupees in shares of L&T in 1993, today we are in 2023, 22 rather, 30 years. I need to go and check, calculate and get back to you. What would have been my value of my investments today? It would have easily been something like running in probably crores, maybe. I don't know. So what I'm conveying here is, please understand, from the enterprise aspect, L&T has created value. Do you agree or you disagree? That is done by finance manager. That is the role of a finance manager in building up the value of an enterprise and the stakeholder is what I'm talking about. Okay, clear? Dividend decisions. That's very, very important. And the next one is, what are the important aspects of financial management? We discussed that. Two important objectives: profit maximization and wealth maximization. I think we had a detailed discussion on that. And coming to functions of a finance manager or a CFO, one is estimating the financial requirements of the business properly. So make proper estimates of funding requirements for short term and long term. Whenever we talk of the word fund, it is finance and fund, broadly the same. But though there are some nuances in it, I'm not getting into that now. So for easy understanding, fund means your financial requirements. Estimate the financial requirements both for short term and long term. Can you ever imagine that? Can you operate a business by delaying the salary for one day? Finance manager have to ensure that every month on the stipulated day, you have enough money in your bank account to pay salary to staff. It's easier said than done. And you need to have adequate money to pay your suppliers. I'm talking about all short-term working capital requirements. And you need to have money to repay your debt, loan installments. You need money to pay your interest on overdraft. So as a finance manager, we need to estimate all these requirements. In fact, we are also going to discuss about budgetary control, where we have a topic called cash budget, which is also a form of a working capital management, which again can be classified as either management accounting or financial management, because it still comes under working capital management. Coming to capital structuring, I told you, capital structuring involves deciding between debt and equity. How much of debt you can borrow, and that's what you all know. Ideal debt equity ratio is 2:1. You can borrow 2 times debt for every 1 capital. Ideally, raising of funds, how are you going to raise your funds? Is it through IPO, or is it through venture capital financing, or is it through any other method? You need to decide on that. Allocation of funds. Allocation of funds is also an important role played by a finance manager. How I am going to allocate my funds? I am going to allocate out of my total funds available for short term and long term, how much? If it is long term, I need to evaluate the proposals and allocate funds for that. Profit planning. As I said earlier, profit maximization being an objective of financial management. As a finance manager, I need to ensure that the company makes adequate profits. If there is no profit in an entity, now let us come to this point here. If a company doesn't make profit and it continuously makes losses, then the first thing anybody would look for is, who is a finance guy? Who is a finance manager? Who is the CFO? Okay, probably this guy is not doing a good job. He is not able to plan for profit of the entity. So what does it mean? I, as a CFO or finance manager of an entity, should ensure that all the activities of an entity are oriented towards making profits. Okay, Maybe initially 1 or 2 years there may be situation of loss for various reasons because you are just starting your business. Today, you know, companies even like Swiggy and Zomato, they are not into profits. They are expanding. Recently, the expansion comes in what form? You would have heard of companies 10 minutes grocery delivery. Have you come across this? Today's service providers, companies which offer you a delivery of groceries in 10 to 15 minutes. Oh my God. Tomorrow we'll discuss in strategic management of the other aspects of running a business. But the expansion happens now. They want to expand their business. Now, how this business is expanding? Take, for example, Swiggy. Swiggy, they have an Instamart. I think we discussed this in some other context also. If you order through this Instamart, Swiggy, they deliver in 30 minutes time. How is it possible? Can you tell me? How are they delivering in 30 minutes time? And you have something called Zepto today, which says I'll deliver in 10 minutes time. You have Grofers, which is now named as what? Any idea? General knowledge. So Grofers now named as Blinkit. Blinkit offers you grocery delivery in 15 minutes time. So as somebody says, no, TV ads are you morning you wake up and go for making a cup of coffee or tea and you realize there's no tea powder. As you think about it, you order and bang, it comes in 10 minutes time, your tea packet. So even making tea is becoming easy today. No need to wait for time to take your tea. So how does it happen? Can you make a guess here? How somebody can deliver you in 10 minutes? Everywhere. Not only in Velachery or Maripatam or Nanganallur or Madurai or Trichy or wherever they are operating. How is it possible? Any idea? Because this is where we need to understand about the decisions regarding how I am going to utilize my funds, how I am going to allocate my funds. Now this happens through creating infrastructure by setting up hubs, units. If I am in Velachery, you know, they have a storage point in Velachery where they stock items. So that is why they are able to deliver to people in 3 kilometers radius. The concept, you take it as Ola cabs or Uber cabs, etc. Everything operates on a similar hub and spoke model. So you set up infrastructure in nearby Velachery to cater to 3 kilometers radius. All your items you stock up there. And once you get an order from a customer, you are able to deliver it within 10 minutes time. Are you able to understand what I'm saying? Now, like this, you have to create infrastructure, one in Velachery, one in Adayar, one in Tiruvannur, so that in Chennai itself, you need to have hundreds of such infrastructure built up, which adds a cost. Can you set up an infrastructure without adequate cost? So each unit may require you to invest some 1 crore rupees minimum. I am talking about example. So this is where the finance manager comes into picture in deciding on how much I should invest, where I should invest, when I should invest, what is the return I'm expecting. All that has to be evaluated by the finance manager. Okay. So allocation of funds, profit planning, understanding, as you said, no, profit planning is very crucial, and without profit, your business is going to succeed in the long term. So in the short term, maybe there could be issues in making profits, but you have to ensure you make adequate profits in the long term. Understanding the capital markets. Today, many companies come up with an IPO and they are successful in generating funds through capital issue in the open market, primary market. So that is an area where, as a finance manager, we need to see whether there are opportunities available to raise funds. Measuring required return. What is the expected return from your business? How much you have actually got as a profit and all that you have to measure. Participation in decision making. Day in and day out, you involve yourself in decision making. So finance managers and CFOs are the people who are looked upon in making decisions. Any type of decision, finance manager is involved, no doubt about that. Whether you are introducing a new product or you are going to make or buy or you are going to do whatever it is, finance manager role is involved because he's the guy who's going to provide money for it. Formulation of financial policy. Now we are going to decide on my financial policy. How I'm going to do all of this has to be determined as a policy, which includes dividend policy, etc. And decide on how much of profit sharing I need to give to shareholders as dividend, how much of profit I should retain in my business as for future expansion purposes. All of this I need to decide as a finance manager. So these are all the functions of finance manager. So objectives of financial management, functions of finance manager. All of you are clear? Okay. So various aspects of financial management is what we today as professionals are expected to do rather than as an accountant. So the role of an accountant today is, I would say, definitely this includes treasury management. Of course, I can add on. Treasury management is where how you utilize your funds which are in surplus effectively. In your house, if you have some extra 1 lakh rupees, what you tend to do, you try to go and put it in a fixed deposit to earn some interest out of it. That is a type of a treasury management. Whereas in a business entity, if you have thousands of crores at your disposal, you need to ensure that it's properly utilized and you get some return out of that. So you have a function called a treasury function, which comes under financial management, where as a treasury manager or a finance manager, I try to make full use of that money for short-term lending. I can make some money out of that in the form of interest, etc. I can put it in short-term interest earning or dividend earning securities, whatever possible. There are a lot of avenues available for short-term lending, money market, what we call it. So as a finance manager, I need to play an active role in ensuring proper usage of funds because otherwise it lie idle. 5,000 crores lying idle in a business is not a good thing to do. So that is where you try to use that 5,000 crores for various short-term investments, etc. And sometimes you may use it for a long-term investment. Many businesses which generate surplus cash, they tend to acquire new businesses. Any examples of recent acquisitions? A company acquiring B company, etc. Because as a finance manager, I play a role in deciding on the acquisition for 2-3 reasons. One is for business expansion purpose, another is for properly utilizing the money I have with me as a finance manager. Can you think of any new recent acquisitions in news?
Yes, sir. Air India is acquired by Tata Group.
Okay, excellent. Good. Air India is acquired by Tata Group. Perfect. So Tata would like to operate this Air India now, and so many intricate points are there. We are not getting into that, but that's a good example of an acquisition. Now, recently also, Tata ventured into this cricket where this IPL is going to be sponsored by Tata. You have heard the news, correct? So, on the news, it's now no more Vivo IPL, it is Tata IPL. Now, there is enough money to be spent on that. You have to give to BCCI and all that, something like you have to pay money, and it's a big business activity in itself because it's a competition, no doubt, but it involves business. IPL is a big competition, but there's a lot of business behind it. CSK team is owned by whom?
India Cements.
Very good. India Cements. India Cements has probably started a subsidiary company where the CSK is a separate company. It's an investment decision of India Cements to invest in a separate company and to generate value by diversifying into a business or activity called IPL. You agree? Clear? Any doubts? So these are all the areas in which finance manager tries to optimize the return by parking the surplus funds available, treasury management and all that, so that the company gets adequate return for that. So various such day-to-day decisions, long-term decisions, short-term decisions, everything is done by a finance manager. So that is why I personally feel also that the role of a finance manager today is dominant. in every single activity of an enterprise, finance manager, whenever I say finance manager, CFO, whatever, he plays a key role. And we as professionals, finance professionals, as I said earlier also, compliance requirements. You add value to the enterprise by ensuring compliance. So company secretaries, cost accountants, chartered accountants, we are all into that role, directly or indirectly. So I think now you are wearing the hat of a finance manager, and already I could see all of you becoming finance head of entities where you sort of understood the role of a finance manager, right? So accountant is 20% or 30%, finance role is 60 to 70% today in any entity. Okay, so having said that, this is primarily to make you understand that yes, that is the way the role has emerged over the years as a finance manager or a CFO, and it is increasing by the day. So we all should feel happy that we are in a domain where we play a key role in ensuring all the objectives of an entity, whether it's a short-term objective of profit maximization or a long-term objective of health maximization. We are the guys who are behind it. Of course, the other players, technical or marketing, they all play a role. We are not denying that. But we are playing a key role to ensure that every effort is properly channelized and we ultimately meet the objectives. I said, you cannot operate a business without making profits. And today, business valuation and all is assuming a lot of significance, whereas people in finance area, we play a key role, business valuation. To give you an example about valuation, I don't know whether I have discussed this earlier with you. Valuation, example, you would have heard of this word called business valuation. How a business is valued. If I'm going to acquire a business, how much I should pay for it? That is what we refer to as business valuation. Now I need to take into consideration the current profit, what is the expected profit and all that. So there was even now I read recently, and there was also an earlier news about a cow or a buffalo, whatever it might be. Somebody is quoting a price of 1 crore for a buffalo or a cow, and people are willing to buy. Can you give me reason as to why you should go and buy a buffalo or a cow for 1 crore rupees? It's a financing decision, right? It's a valuation which is involved. A cow valued at 1 crore rupees. A cow or a buffalo can be valued at 1 crore rupees. Can you give me some reasons behind this valuation? People to buy, but that guy is not selling actually. The valuation is 1 crore, but the guy is unwilling to sell. In Punjab, I read somewhere recently, but it's old news. Everywhere this news keeps coming up time and again. Any idea what drives the valuation of a cow or a buffalo? You'll be surprised to know that this cow or a buffalo is a high milk yielding variety. One. So on an average per day, it gives you a 10-liter milk or 20-liter milk or whatever it is. That is one side of the story. That is like revenue. There is another interesting capital appreciation. You know how? There are 2-3 things involved in this. One is this cow. Let us take cow as an example. This cow is a high milk yielding breed. So if the cow is going to yield calf, it's like bonus share, no? When you get a bonus share from your share, is it good or bad? Okay, in a life cycle, let us say, I'm not a veterinarian to tell this, but just as an example, a cow is going to yield the calf 3 times or 2 times or whatever, I don't know actually. Forget about it. It's capital appreciation. The second thing is, interestingly, this cow, what I'm talking about, is participating in a lot of competition and it wins every competition hands down. And every time it wins prizes 10 lakhs, 5 lakhs, 20 lakhs, 30 lakhs, etc. Does it make sense to offer 1 crore and buy the cow now? This is business for you. I'm telling you, students, dear students, that after our classes in financial management and strategic management, you are going to be big business guys. Your thinking will change. You are thinking as accountants, you are thinking as just what I'm supposed to do is going to change. I'm telling you, for your lifetime, you will change your mindset. It's going to be really, really taking you to the next league as to what I'm going to do as finance manager and what I'm going to do as. We are also going to discuss about from tomorrow strategic management. It's a wonderful subject. Okay, so get ready for that also. So this is how I can summarize regarding the aspect of the syllabus and subject of financial management. As I said, all of this comes as a part of your academic requirements. Each one is a lesson for you. As I said already, cash flow analysis, fund flow analysis, working capital management, cost of capital and capital budget, cost of capital, capital structure, capital budgeting, working capital management, and dividend decisions. All this is part of your syllabus. So we are going to cover that one by one. So in the next class in financial management, as I said, I will be starting off with ratio analysis, which is nothing but analysis of financial statements. And after that, I will be taking up working capital management and all that. So we have a lot of interesting topics in this subject, financial management. So I request all of you to attend all the classes, live classes in particular, as we are having it. Please attend it. And also, the same topic today, what I discussed with you, I have given a different dimension in a video class. You can go through that also. So because the live classes and the video classes, I wanted it to be slightly, to an extent possible, different, so that you don't get to hear the same thing in the video class also. So you also, I'll also try and share, I have been sharing it also. So try and share, try and go through those video classes also. Hopefully you have time. And so this live classes plus video classes, maybe you are all a batch where you have an option to get both. Maybe in the days to come, we may offer any one only, because either live classes or video classes, we may not give both. So video classes and live classes, you are the batch. Last batch plus this batch, maybe one more batch. You will, because of administrative reasons, we are giving both. Okay, only for selective topics where we are not having time to go through the slide classes, I will only give you the video class. Otherwise, we will get both also. I am also trying to solve similar or same or different types of problems. So kindly attend all the live sessions. It will be useful for you. And so tomorrow we will start with strategic management, as I already informed you. Same time, 7 to 8:30. So kindly attend the live class and try to be, as usual, participative and active. And thank you all for joining in today. Hope you had a good understanding of the subject of financial management. So, and catch up tomorrow. Have a great day ahead. Thank you once again. Bye.
Thank you, sir.
Thank you, sir.
Thank you. Take care. Yeah.
Thank you, sir.
Thank you. Take care.